If you've ever thought about investing in real estate, you've likely come across Brandon Turner's The Book on Rental Property Investing. This comprehensive guide outlines the essential strategies and techniques that can help you generate wealth through rental properties. Please hit subscribe button for more informative videos. Takeaway number 1. Why you should become a rental property investor. Purchasing with leverage. One of the biggest advantages of real estate investing is the ability to use leverage, borrowing money to invest in a property. Unlike other investment avenues, such as stocks or bonds, real estate allows you to purchase property without needing to pay the full price upfront. For example, if you're looking to buy a $200,000 property, you don't necessarily need $200,000 in cash. You can use a mortgage to finance the majority of the purchase and only need to pay a smaller down payment. This leverage can work in your favor in two ways. You can get started sooner with less initial capital. You can increase your returns on investment by using other people's money to finance the property. Hustle for greater returns. Investing in real estate is not a passive activity. It requires hustle and smart decision-making. The more time and effort you put in, the greater your returns can be. For instance, you can rehab properties yourself to increase their value and rental potential, network to find better mortgage deals, property management services, or even investment partners. Spend time searching for the best deals, ensuring you get maximum value for your investment. Unlike the stock market, where insider trading is illegal, real estate investing encourages you to take advantage of the inside knowledge you have access to. Whether it's finding undervalued properties or negotiating below market prices, your hustle and insider knowledge can help you secure better deals and higher profits. Multiple ways to profit. Rental properties offer multiple ways to generate wealth. Appreciation, increasing value over time. Cash flow, rental income after expenses. Tax benefits, deductions, depreciation. Loan paydown, equity accumulation through mortgage payments. These different sources of profit allow investors to build wealth in multiple ways, making rental property investing a versatile and long-term financial strategy. Not having to be present. One of the best things about rental property investing is that once the property is set up, it can generate income without requiring constant involvement. Even if you decide to take a day off, your rental property can continue to bring in money. With the right property management, maintenance, and systems in place, you can build a largely passive income stream. Takeaway number 2. Why you shouldn't become a rental property investor. As enticing as rental property investing may seem, it's not for everyone. Turner warns about the potential downsides and stresses that investors need to fully understand the challenges before diving in. Building wealth takes time. Real estate investing is a long-term game. This isn't a get-rich-quick strategy. To become truly wealthy through rental properties, you need to take consistent, disciplined action over an extended period of time. It can take years, sometimes decades, before the property appreciates significantly or before you generate enough rental income to make a substantial impact on your finances. It may become all-consuming. Owning rental properties can be all-consuming, especially in the beginning. From handling repairs to dealing with tenants, you'll find yourself thinking about your properties all the time. There's a risk that your rental properties could dominate your thoughts and actions, making it hard to focus on other parts of your life. Difficult tenants. Not all tenants are ideal, and some may cause headaches. Turner highlights the challenge of dealing with tenants who are consistently late with rent, cause property damage, make excuses, or fail to communicate effectively. Managing tenant relationships requires a certain level of patience, communication, and problem-solving skills. If you dislike handling conflict or managing people, rental property investing may not be the best fit for you. Potential for loss. Like any investment, there's always a risk of losing money in real estate. Unexpected costs, poor market conditions, or long periods of vacancy can lead to financial losses. Turner advises that proper research, planning, and risk management strategies are crucial to minimizing the chances of failure. Takeaway number 3. The 4 wealth generators. There are 4 key ways to profit from rental property investing. Understanding these wealth generators helps you evaluate which strategies will work best for your goals. Appreciation refers to the increase in the property's value over time. This can be caused by factors like inflation, population growth, or urban development. There are two types of appreciation. Natural appreciation, driven by external factors like inflation and limited supply. Forced appreciation, generated by improvements or renovations you make to the property, such as remodeling or upgrading appliances. While appreciation is a significant source of profit, it's less predictable and can take years to materialize. Cash flow is the most direct form of profit from rental properties. It refers to the money left over from tenant payments after you've covered expenses, mortgage, property taxes, maintenance, etc. If a property doesn't generate enough cash flow, it might not be a good investment. To ensure positive cash flow, you must calculate both the income and expenses of the property. Income is primarily from rent, but could also include additional charges for parking or utilities. Expenses include mortgage payments, insurance, property taxes, maintenance, and property management fees. Tax savings. Many countries offer tax advantages for property owners. These can include deductions for mortgage interest, property taxes, repairs, and depreciation. These tax benefits help to reduce your overall tax liability, making rental properties a more efficient way to build wealth. Loan paydown. Each mortgage payment you make pays down the principal amount, which increases your equity in the property. Early on, most of your payments go toward interest, but over time, more of the payment goes toward the principal, which accelerates your wealth accumulation. Takeaway number 4. What makes a good deal? Now that you understand the 4 wealth generators, it's important to learn how to evaluate whether a rental property is a good deal. The key metric to focus on is cash flow, but appreciation can also play a role in overall profitability. How to calculate cash flow? To calculate cash flow, you need to subtract all property expenses from the rental income. Here's how to break it down. Income, the monthly rent you can charge. Use tools like local listings, Craigslist, Airbnb to determine fair market rent. Expenses, operating expenses, mortgage, taxes, insurance, utilities, etc., and capital expenditures, roof replacement, major renovations. Pros, leverage, hustling for greater returns, multiple ways to profit, passive income. Cons, long-term commitment, potential for difficult tenants, risk of loss. Wealth generators, appreciation, cash flow, tax savings, loan paydown. If you enjoy this video, please don't forget to like, subscribe, and press the bell icon. See you in the next video.